jumping straight into CoreWeave today. Everyone is watching the price action, but the real story is the $56 billion backlog and the AI infrastructure inflection point.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this massive battle between the lawyers and the fundamentals, make sure you hit that subscribe button and smash the like.
Yeah, you'll want to.
If you want the lowdown on the movers that actually matter to your portfolio, this is definitely the place to be.
You know, it's funny. Usually when we talk about a stock that's corrected 50, maybe 60% from its highs, we're kind of doing a post-mortem.
Right, dissecting what we're wrong.
Exactly. A broken company, a failed business model. But CoreWeave, it feels completely different.
Different is doing a lot of heavy lifting there. I mean, this is a name that hit a peak of, what, $187 not that long ago?
It felt unstoppable.
It did. It was the darling of the private markets, then the public markets, and then boom, the floor just fell out down to double digits.
But then just this week, you see this 15, 16% pop almost out of nowhere.
It feels less like investing and more like betting on a heavyweight price fight.
It really is a tug of war. But instead of two boxers, you have two completely different realities clashing.
Okay, so in one corner?
In one corner, you have what I call the legal noise. You've got class action lawsuits, allegations of fraud, hidden delays. I mean, really scary stuff that usually sends institutional money running for the hills.
And in the other corner?
The fundamentals. And not just, decent numbers. We are talking about Nvidia.
Arguably the most important company on the planet right now.
Betting billions that CoreWeave is the future backbone of AI. It's the ultimate battle of sentiment versus substance.
That's the setup. It's the lawsuit versus the backlog.
And honestly, the numbers coming out of this company they're mind-bending. I think we have to start with the bull case. Because if you ignore the legal stuff for just a second, and you just look at the growth, you'd assume this stock was trading at $300.
Let's look at the revenue, because that is usually where the truth hides.
Right.
In the third quarter of 2025 alone, they hit $1.36 billion.
Which is up 134% compared to the same quarter last year.
Just pause on that for a second. We see high growth percentages in small tech startups all the time.
Yeah.
It's easy to grow 100% when you're making, $10 million.
Of course.
But triple-digit growth at $1 billion scale, that's rare air. That is hyper-growth territory that we almost never see.
It really is. And the guidance for the full year 2025 is over $5 billion. But here's where it gets really crazy.
Go on.
They're projecting 2026 to double. Again, to around $12 billion.
That trajectory is almost vertical.
Okay, but let's play devil's advocate here, because I know some listeners are probably rolling their eyes.
Sure.
When a company says, hey, we're going to double to $12 billion, my skepticism radar just goes off. Anyone can put a number on a PowerPoint slide. How real is that $12 billion?
That is the key question. And the answer, I think, lies in one specific metric. The backlog.
The backlog. This is so crucial for people to understand.
This isn't just a forecast. This isn't just customer interest.
No. In the cloud world, backlog means signed contracts. It's usually take or pay, meaning the customer pays you whether they use the servers or not.
Precisely. These are customers who have legally promised to pay money in the future to secure access. And CoreWeave's backlog right now, it sits at $56 billion.
$56 billion, up 4 times year over year.
That number is it's larger than the GDP of some small countries.
So when the bears say this is just hype, they have to reconcile that with $56 billion of signed paper. You don't sign that kind of money unless you are desperate for the product. It locks in their revenue for years.
And it's not just any customers, right? We aren't talking about small crypto miners anymore.
No. This is Microsoft, OpenAI, the titans of the industry. They are effectively reserving their spot in line at CoreWeave for years.
They're terrified of running out of compute, so they're booking it out through 2027, 2028.
But why, though? That's what I keep asking. Microsoft has Azure. They have infinite money. Why do they need to sign a massive contract with CoreWeave?
Because CoreWeave has the Nvidia seal of approval.
Yeah.
You simply cannot talk about this company without understanding the Nvidia dynamic. It's probably their strongest moat.
Nvidia has invested, a total of $8.3 billion into the company?
A staggering amount. It's a strategic marriage, not just an investment.
That includes a recent $2 billion equity infusion, right?
It does. But to answer your question about why Microsoft is there, it's not just about the cash NVIDIA put in. It's about the access NVIDIA gives back. CoreWeave gets the VIP treatment.
And what does VIP treatment look like in the silicon supply chain? Is it just like better pricing?
It's way more than pricing. It means they get the new toys before anyone else. We're talking early access to the Vera CPUs, the Rubin platform.
While other cloud providers are begging for allocation.
CoreWeave has the trucks pulling up to the loading dock.
And for those listening who aren't deep in chip architecture, the Rubin platform is the next big thing. It's the generation after Blackwell. This is the gear that's going to train the AI models we haven't even dreamed of yet.
Right. So if you're developing the next GPT-6, you need Rubin. And while competitors might be waiting in line, CoreWeave is already racking and stacking it. That speed is everything.
So if I'm a startup or even a big company and I need the absolute fastest, newest chips to stay competitive, CoreWeave is practically the only place I can go to get them at scale right now.
That is the differentiation. People keep comparing them to Amazon AWS or Microsoft Azure.
Thinking they're just a smaller version.
But they aren't trying to be a general-purpose cloud. They're not trying to host your website or store your vacation photos.
They aren't a department store cloud.
No, they are building AI factories. That's the term they use. They have 41 operational data centers right now with a plan to reach over 5 gigawatts of capacity by 2030.
5 gigawatts. Let's contextualize that. A gigawatt is roughly enough energy to power 750,000 homes.
So they're planning to consume enough power for nearly 4 million homes.
Just for AI calculations, that's industrial scale. That is nation-state levels of power consumption.
It is. But building power plants is expensive. And that brings us to the profitability question. Because if you look at the headlines, you see net losses.
A projected loss of about $1.09 billion in 2025.
And this is where a lot of retail investors get scared. They see billion-dollar loss and they run. They think this is another dot-com bust. They're just burning cash.
But we need to simplify this. Why are they losing money?
They are losing money on paper because they are spending an absolute fortune building these factories. But, and this is a huge distinction, they are operating cash flow positive.
Okay, let's break that down for the non-accountants listening. Net loss includes things like depreciation, right?
Exactly. It's an accounting measure. But operating cash flow means the actual business of selling compute time is bringing in more real cash today than it costs to run the servers today.
So the core business works. The unit economics are healthy. They are making money on every hour of compute they sell.
Bingo! They are just spending every penny they make, plus billions in debt and investment to build more factories as fast as humanly possible.
It's like a hotel chain. Imagine you build one hotel, it's fully booked, you're making good money, but instead of pocketing that profit, you decide to build 50 more hotels all at once.
Your bank account drains. On paper, you're losing money because of all the construction costs.
But the business of running the hotels is profitable. That's a perfect analogy.
So when do they stop building and start collecting the rent, so to speak?
The expectation is that they'll turn EBITDA positive, so earnings before all the accounting stuff, by the middle of 2026.
So the profitability horizon is actually very close. We're not talking 2030 here.
So massive growth, Nvidia's backing, a $56 billion backlog, and the losses are just growing pains. It sounds perfect.
It does sound perfect, but
There is always a but. If it were that perfect, the stock wouldn't be down 50%.
the stock didn't drop 50% from its highs for no reason. We have to look at the flip side. Let's talk about that dark cloud hanging over this company.
The litigation cloud. This is the bear case, and honestly, it is ugly. It's never good when the lawyers get involved.
The reason the stock got hammered is a series of class action lawsuits. The allegations are very specific. They claim CoreWeave overstated its capacity and hid severe delays at their Denton, Texas facility.
And this was between March and December of 2025.
Denton, Texas. It sounds like a small detail, but a delay in one major facility isn't like a Starbucks opening a week late.
No, it creates a domino effect. The lawsuits allege that management knew this facility was way behind schedule.
That they were reliant on a single third-party supplier that wasn't delivering.
But they kept telling investors everything was fine. They allegedly kept the guidance high while knowing the concrete wasn't being poured fast enough.
And that is the legal overhang. It creates fear. It's not just about a delayed building. It's about trust.
Right. If they hid problems in Texas, what else are they not telling us? Are the other 40 data centers actually running at full steam? That's what the market is whispering.
Exactly. It questions their ability to execute. Can they actually build these 5 gigawatts they promise? Or are they just good at signing contracts they can't fulfill?
Because if you can't deliver the compute, that $56 billion backlog, it just disappears.
Uh,
Microsoft will pay for servers that don't exist.
And when you combine that fear with the financial reality, it gets tense. We talked about the spending, 12 to 14 billion dollars in 2025 just on infrastructure.
That is capital intensity with a capital C. It's enormous. And to fund that, they've taken on a mountain of debt. We're talking in the $14 billion range.
14 billion in debt. Now, debt is fine when you're growing like crazy, but what happens if AI demand slows down even a little bit?
That debt becomes an anchor. If the AI bubble bursts or even just leaks a little air, CoreWeave still has to pay the interest on $14 billion.
It's a fixed cost that doesn't go away.
And it's not just the debt they already have, they need more.
Right. They have a projected liquidity gap of nearly $10 billion in 2026. That means they do not have enough cash in the bank right now to pay for the factories they plan to build next year. They have to raise more money.
Which explains the constant fundraising, like that recent cash injection from Nvidia. They are hungry for cash. It's a race against the clock.
And while they're burning that cash, look at who is selling the stock.
The insiders. This is always the metric that makes me nervous.
Insider sentiment is a huge red flag for the bears here. In the last few months, we've seen over $800 million in shares sold by insiders.
800 million. That includes their major backer Magnetar and executives like Brandon McBee. That's a lot of chips to take off the table.
It is. And look, executives sell for all kinds of reasons. Buying a house, taxes, whatever. We always say insiders sell for 100 reasons, but they only buy for one.
But the optics.
The optics are bad. When your stop is down 50% and you're trying to sell this next trillion-dollar company story, seeing $800 million walk out the door.
It's hard to tell investors to buy the dip when the people running the company are selling into it.
It suggests they want to de-risk their own portfolios. Or they see the risks with Denton and the lawsuits and want to secure their own bags. It's a mixed signal at best.
So we have this clear divide. The revenue and the backlog say buy. The lawyers and the insiders say be careful. It feels totally binary.
It is very binary. This isn't a stock that is going to trade flat. It's either going to double from here or get cut in half again.
So for the people listening, how should they navigate this? What should they be watching for the next few months to figure out who's right?
We have some very specific triggers coming up in 2026. If you're in this stock or thinking about it, you need to mark your calendar.
Okay, what's the first one?
It all goes back to Denton, Texas. Getting that data center online in Q1 of 2026 is the critical physical catalyst.
It's the show me moment.
Exactly. If they cut the ribbon on that facility, it proves they can execute. It quiets the lawsuit allegations. It shows the factory is open for business.
But if Q1 comes and goes, and Denton is still a construction zone,
Then the lawsuits gain traction. The fraud narrative gets louder. And the stock probably takes another leg down because it validates the entire bear case.
and there's a legal date for that too, right?
March 13th, 2026. That is the deadline for the lead plaintiff in the class action suits to be named.
So that's when we see how serious this case is really going to be.
Expect volatility around that date. If the case looks weak, the stock could rally. But if it looks like they have a smoking gun, emails proving executives knew about delays and lied, watch out.
So we have the construction deadline, the legal deadline, and then the financial pivot.
The EBITDA inflection, mid-2026. That's the moment the narrative can change from cash-burning startup to profitable tech giant.
And that's tied to a massive increase in their capacity coming online, right?
Yes, a 45% increase in contracted compute hours is scheduled to activate by mid-2026.
A 45% jump. That's like an airline suddenly adding 50% more flights to its schedule overnight.
It is. If that capacity comes online and those billings start hitting the bank account, the cash burn problem starts to solve itself.
So the next 6 months are purely about execution. Finish the factory, navigate the legal deadline, and flip the switch on that new capacity.
If they do those three things, the lawsuits become noise, the debt becomes manageable, the insider selling is forgotten.
But if they miss on any of them,
The debt spiral becomes a very real concern.
it's just rare to see a company with this much backing and this much revenue also carrying so much existential risk.
That's the lowdown. It is a high-stakes trade. You have triple-digit growth and Nvidia's backing, but it's trading at a discount because of lawyers and construction delays.
Not for the faint of heart. But the discount is tempting.
Definitely. But here is a final provocative thought for you to chew on. Ask yourself this. Is the market currently pricing CoreWeave like a failing construction company because of a few delayed buildings?
Or is it pricing it like the next AWS because of that $56 billion backlog?
The answer really lies in your belief about AI itself. If you think AI demand is a bubble, CoreWeave is a dangerous debt trap.
But if you think this is the new industrial revolution,
Then CoreWeave is building the railroads and the train is just leaving the station.
well said.
That's it for this edition of the Easy Money Show. Make sure you subscribe so you don't miss the next breakdown. We'll see you next time.